Gold and silver are loading a major move, and the paper market is trying to drown the signal in volatility right as the real-world supply chain starts to veto the easy narrative. And if you stay with me, you'll know exactly what to watch over the next 1 to 2 weeks, the one calendar window that turns a normal pullback into a slingshot, and the one market structure tell that exposes whether this is just noise or the start of the next leg that catches people offside. Right now, the easy story sounds comforting. Metals ran hard, now they're cooling off, and that's that. But comfort is not how markets work when positioning is crowded, liquidity is thin, and hedging flows are forced. Metals don't top because someone feels emotional. They top when the mechanism runs out of fuel. And the uncomfortable truth is this: the fuel system for gold and silver hasn't even finished resetting, which means the chop you're seeing isn't a warning sign by default. In this window, chop is often the tool. And that's where the real pressure starts. Let's put a clean frame around the moment without getting hypnotized by exact ticks. Gold just printed fresh highs recently and then backed off into consolidation, doing what it almost always does after a violent run. It tests the conviction of everyone who arrived late. Silver did the same thing, only louder, because silver is built to be louder. That's not a slogan, that's structure. Silver is thinner, more levered, more reflexive, and more sensitive to forced flows than gold, so it doesn't drift, it snaps. And when silver snaps, it doesn't just move price, it moves behavior. But that's not the part that matters. What matters is that the headline chart can look weak at the exact moment the underlying physical signal is getting stronger. That is the hidden detail the mainstream misses again and again. When metals pull back, everyone stares at the screen and pretends it's the whole world. Meanwhile, the people who touch metal, fabricators, refineries, wholesalers, importers, start telling a different story in the only language that matters: urgency, availability, and premiums. Not opinions, not vibes, spreads, delivery windows, the cost to get metal now versus later. Because if this one relationship flips, the math changes. Here's the simplest way to understand the conflict. There are two prices. There's the paper price, the futures-driven, liquidity-driven price that can be shoved around by margin, hedging, and risk limits. And there's the physical price, the price you discover when somebody needs metal in a specific place, in a specific form, on a specific timeline, and they cannot roll that need. In calm markets, these two prices stay in a polite relationship. In stressed markets, they argue. And when they argue, the spreads tell you who's winning. The next detail is what flips the whole setup. Because the move you are watching isn't just a story about inflation or geopolitics or central banks, even though all of those can matter. It's a story about market plumbing, the calendar, the roll, the hedge, the margin, the inventory bucket that is actually deliverable, and the arbitrage that forces paper to eventually respect physical. If you understand the plumbing, you stop being emotionally manipulated by whipsaws. And you start seeing volatility as a reveal, not a threat. So let's talk about the why now trigger, because this is the piece that turns a normal chart pullback into a trapdoor. Early January is one of the most deceptive liquidity environments of the year. The holidays are gone, but not everyone is fully reloaded. Risk committees are resetting. Liquidity is patchy. Books are being rebalanced. And most importantly, a lot of participants are dealing with mechanical flows they did not choose. That sounds abstract until you see what it forces people to do. When big funds and benchmarks rebalance, they don't care about your thesis. They sell or buy because the weightings tell them to. When dealers hedge options exposure, they don't care about your thesis. They buy or sell because their delta changed. When margin requirements change, leverage players don't care about your thesis. They cut because they have to. Those are not opinions. Those are constraints. And in commodities, especially silver, constraints move price more than narratives do. This is why you can see a situation where the metal is fundamentally tight, the medium-term setup is constructive, and price still gets smacked down in a way that feels personal. It's not personal, it's plumbing. And when plumbing drives price, the move can be fast, ugly, and temporary, until it becomes fast, ugly, and unstoppable in the other direction. But you only get that second part if you recognize the first part for what it is. Now, let's pull one of the most important levers out into the open: forced selling. In metals, forced selling usually shows up through three channels. 1, a volatility spike triggers risk parity and systematic strategies to degross. 2, a margin hike or a funding squeeze forces leveraged longs to liquidate. 3, dealers and market makers adjust hedges around options, strikes, and expiries, creating pinning in air pockets. In all three cases, price can fall even while the underlying physical situation is tightening. And that's where the real pressure starts. Let us make this concrete with a clean mechanism explainer that will save you money, margin, and leverage. Futures are powerful because you can control a large notional position with a smaller amount of capital. That's fine until volatility rises. When volatility rises, exchanges and brokers often require more margin, not because they're evil, because they're managing default risk. But that margin increase is not neutral. It forces behavior. If you're leveraged and you don't have fresh cash ready, you sell. If enough people are forced to sell at once, the selling becomes the signal. And that signal attracts more selling because systematic strategies and risk controls respond to the same volatility that the margin hike created. That feedback loop is reflexivity. And silver is basically built for reflexivity. Here's the micro truth you need to tattoo on your brain. The market does not need to agree hot with you this week for you to be right on the setup. It only needs to reveal whether the stress is paper only or physical rooted. And the best way to see that is not the headline price, it's the structure under it, because the spreads don't lie for long. So let's talk term structure, contango, and backwardation without making it a textbook. In a normal precious metals market, you usually have a small contango. Future months trade slightly higher than the spot or front month, largely because of carry, financing, storage, insurance, and the opportunity cost of holding metal. That's the market saying time has a cost. But when the front end tightens, when immediate metal becomes scarce or urgently demanded, the curve can flatten or even invert. When that happens, it's the market saying now is more valuable than later. And that is not a sentimental statement. It's a supply chain statement. If you ever want to know whether a pullback is just speculative froth cooling off or something deeper, watch the front end spreads and the cost to borrow metal. When the lease rate spikes, when the nearby spreads behave wrong, when the curve stops paying you to wait, that's a clue that real metal is being pulled forward. And once real metal gets pulled forward, paper has to follow eventually, because paper settles into physical realities through arbitrage and delivery constraints. But that's not the part that matters. The part that matters is deliverable inventory, because people throw around inventory like it is a single number, and that's how you get misled. In metals, inventory has categories, and those categories are everything. There's metal that exists. There's metal that exists in a vault but is tied up, owned, pledged, earmarked. There's metal that exists but is the wrong bar size, the wrong location, or the wrong form for delivery. And then there's metal that is actually deliverable against the contract, meaning if someone stands for delivery, it can be used without drama. Those are not the same bucket, and the market can look well supplied on paper, while the deliverable bucket is tight enough to raise eyebrows. The next detail is what flips the whole setup, because the paper market is confident as long as it believes delivery pressure won't matter. The physical market gets loud when it senses delivery pressure might matter. And silver in particular has a history of episodes where the borrowing cost and the spread structure start screaming before the headline price does. That's why people who only watch spot charts get whiplashed. They're watching the reflection, not the object. Now layer in the global arbitrage piece, because this is where the two prices become one. In a truly connected market, if physical premiums rise in one region, especially in large consuming hubs, arbitrage desks respond. They source metal where it's cheaper, ship it where it's dearer, and hedge the price risk using futures. That flow does two things at once. It drains available inventory in the cheap region, and it adds demand in the paper market because hedges have to be put on. So when you see persistent premiums and tight delivery windows, you're not just seeing local demand. You're seeing the early stage of a pipeline being rerouted. And rerouting pipelines always shows up in spreads before it shows up in headlines. This matters even more because gold and silver aren't isolated. They sit inside a macro system. Real yields, currency stress, and geopolitical risk all feed into the bid for insurance. When real yields fall or become unstable, the opportunity cost of holding gold changes. When currencies wobble, the value of a non-liability asset becomes more obvious. And when geopolitical risk rises, the appetite for reserve diversification tends to grow. That doesn't guarantee straight line gains. It guarantees interest. And interest is the raw material for squeezes when structure is tight. That's where it gets uncomfortable for skeptics of institutions. The biggest and steadiest gold buyers are in OT retail. They're sovereign and institutional actors who don't tweet, don't panic, and don't chase headlines. They buy because they're managing regime risk, sanctions risk, reserve risk, settlement risk, confidence risk. That bid tends to be patient. And patience is dangerous for short sellers because patient demand quietly reduces float. You don't notice float reduction until you need float. And in metals, you always need float at the worst time, when volatility is high and liquidity is thin. And that's where the real pressure starts. Now, silver has an extra layer that makes it uniquely combustible: industrial demand and procurement psychology. Silver is not only a monetary metal, it's an input. And procurement is not like speculation. Speculation can roll a contract. Procurement has a deadline. Procurement has an assembly line. Procurement has a penalty if parts aren't delivered. So when supply risk appears, whether through shipping disruptions, refining bottlenecks, or policy changes that complicate export flows, procurement behavior shifts from optimize price to secure supply. That shift doesn't sound dramatic until you realize what it does to timing. It pulls demand forward, and pulling demand forward is exactly what tightens the front end of the curve. Because if now matters more, spreads change first. And yes, policy risk can be a real catalyst in this space. When you hear reports about tighter licensing, controls, or friction around refined silver exports in major supply corridors, you don't need to treat it as a guaranteed catastrophe to respect the mechanism. The mechanism is simple. Friction increases delivery uncertainty. Delivery uncertainty increases the value of nearby supply. Nearby value shows up in lease rates and spreads. Spreads force hedgers and arbitrage desks to reposition. Repositioning changes the paper market, even if the headline crowd is still debating whether the story is real. The next detail is what flips the whole setup. Now let's talk options, because this is where the chart can look like it among us, behaving irrationally, when it darks actually behaving like math. Dealers and market makers often sit on the other side of options flow. When the market buys calls, dealers can end up short calls. When you're short calls, your risk increases as price rises, so you hedge by buying the underlying or buying futures. That buying can add fuel to an up move, but the reverse is also true. Around key strikes and expiries, hedging flows can pin price, compress it, and then suddenly release it when a strike is cleared or when gamma exposure flips. That's why you see days where metals feel magnetized to a level, and then suddenly they're not. Gamma is just a fancy word for how quickly delta changes. When gamma is high, small moves in price force large hedging adjustments. That can create a squeeze if the market is moving upward through heavily owned call strikes because hedging becomes forced buying. It can also create an air pocket if price drops through key levels and hedges flip to selling. The point is not to memorize Greek letters. The point is to know that in these windows, thin liquidity, rebalancing, option rolls, price can be driven by hedging math, not human conviction. And that's where the real pressure starts. So what's the proof stack? What are the independent signals that, when stacked together, tell you whether this setup is building or breaking? You want at least 5 layers, because one layer can fool you. Here's how you stack it in a way that keeps you rational. First layer, term structure. Is the front end tightening relative to the back end, or is the curve relaxing? If nearby spreads stay firm even when spot price pulls back, that's a sign immediate supply is still valued. If the curve pays you to wait again aggressively while spot falls, that can signal the physical urgency is easing. That's not everything, but it's a cornerstone. Second layer, borrow cost and lease conditions. You don't need perfect data to track the concept. When it becomes more expensive to borrow metal, it tells you the market is competing for inventory. Competition for inventory often precedes competition for price, because once the inventory is spoken for, the price has to adjust to ration demand. Third layer, inventory quality, not just quantity. Watch what happens to deliverable stock versus total stock in the ecosystem that matters for settlement. If metal is there but not deliverable, you can still get stress. If deliverable stock is building, that can reduce squeeze risk. The key is to stop treating inventory as a single number. The market doesn't. Fourth layer, physical premiums and availability symptoms. Are coin and bar premiums compressing or widening? Are delivery times shortening or lengthening? Are large hubs showing evidence of urgency? Even anecdotal symptoms can matter when they align with structure. One symptom is noise. A cluster is a signal. Fifth layer, institutional flow tone. ETFs, managed money positioning, and central bank behavior don't need to be tracked perfectly to be useful. You watch for the tell of behavior. Are flows supporting dips? Are rallies being met with fresh selling or just profit taking that quickly gets absorbed? Is there consistent buy the dip action that prevents deep follow through? That absorption is often the difference between a normal correction and a springboard. Sixth layer, the one most people ignore, cross-market comparison. Watch how gold behaves relative to currencies, relative to real yields, relative to risk assets. Watch how silver behaves relative to industrial metals and to gold. When silver outperforms gold during stress, it can be a sign of speculative heat. When silver holds structure despite volatility, it can be a sign of underlying tightness plus optionality. The relationship matters because it tells you whether the move is purely fear or partly procurement. Now, bring that back to the chart, but not as fortune telling. Use the chart as a map of forced behavior. There are 3 zones you care about in any metals move like this. The recent swing high zone, the pullback base zone, and the decision zone in the middle where price repeatedly reacts. You don't need exact numbers to treat these as real. You can see them on any chart. And the reason they matter is not mystical. They matter because that's where positions were built, where pain is concentrated, and where hedges are anchored. If gold reclaims and holds above a prior breakout area that was recently lost, that's not just bullish. It forces short-term bears to cover because their invalidation is triggered. If gold loses the pullback base on a closing basis and cannot reclaim it quickly, That's not just bearish. It invites systematic selling and shakes out weak hands, which can still be constructive later if spreads refuse to loosen. The key is the reaction, not the headline, because the reaction tells you who is trapped. And trapped positioning is rocket fuel in metals. Silver is the same story, only more violent. Silver will often probe below support, scare everyone, and then reverse so fast you don't get to think. That is why people get emotionally destroyed in silver even when they right on direction. They size wrong, they leverage wrong, and they confuse noise for invalidation. And that's where the psychology shield comes in. Here's the psychology shield you need right now, especially if you were a skeptic of institutions and you've watched markets do impossible things. Volatility is not evidence against the thesis. Volatility is the market's way of harvesting bad positioning. The market's job is not to validate your beliefs. Its job is to find where you are emotionally fragile and extract a price for it. That extraction happens through 3 tricks. Trick 1, the fake breakdown. Price dips below a well-watched level just long enough to trigger stops, headlines, and panic, and then snaps back. This is common in thin liquidity windows because it doesn't take much capital to run the level, and once stops trigger, the market gets free liquidity. That free liquidity becomes the fuel for a reversal. Trick 2, the late headline. After a move has already happened, a clean narrative appears. People mistake the narrative for a cause. It's often just a story to help you accept what already happened and to lure you into chasing at the worst moment. Trick 3, the confidence whipsaw. Price chops in a tight band with sharp spikes, making you feel like nothing's working until you either overtrade or give up. Then the move happens without you. The market doesn't need you to be wrong. It needs you to be off balance. So how do you defend yourself? You separate signal from noise. Signal is structure, spreads, curve behavior, absorption, reclaim levels, and the ability of price to recover after stress. Noise is intraday chaos designed to manipulate. You also pre-commit to 2 scenarios, so you're never surprised. Scenario 1 is the controlled pullback and retest. In this scenario, gold and silver pull back into their base zones, liquidity improves, weak hands exit, and then price retests the breakout area from above. The tell that scenario 1 is happening is that dips get absorbed, the curve doesn't collapse, and the market keeps snapping back above key closing levels. This is the market building a platform. It feels boring, but it's bullish if structure holds. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't give you the perfect entry. It rips through resistance during thin liquidity, often around an expiry, a roll, or a sudden policy headline. The tell here is that once resistance breaks, price doesn't immediately mean revert. Instead, it accelerates because hedging flows and short covering pile on. This is where gap risk lives, both up and down, because liquidity thins and stops get jumped. It's thrilling, but it's dangerous if you're sized wrong. Both scenarios can be bullish longer term. Both can feel terrifying in the moment. The difference is how you manage your exposure so you don't get forced into the market's game. And the market's game is always the same, make you act at the worst time. Now let's get practical. What comes next, this week and next week, in a way that turns chaos into signals? You want a simple checklist, not 100 indicators. 5 things. Because if you track these 5 things, the market can't gaslight you. 1. Watch the front month versus next month behavior in both metals. You're looking for whether the front end stays firm relative to the back end. If you see front-end firmness during a pullback, that's constructive. If you see the curve relax aggressively while price falls, that can indicate the physical urgency is easing, at least temporarily. 2. Watch for availability symptoms. If retail premiums and delivery times remain elevated even as price pulls back, that's a sign demand is not purely speculative. If those symptoms ease rapidly, it can mean the pullback is doing its job, cooling demand, or it can mean supply is loosening. Either way, it's information. 3. Watch the reaction to key chart zones on daily closes, not intraday spikes. In this window, intraday moves are often engineered. Closes are harder to fake because they affect risk models, margin, and weekly reporting. If gold and silver can defend their base zones on closes, that's a signal. If they lose and cannot reclaim quickly, that's a warning, but not necessarily the end, because a deeper shakeout can still be the setup if spreads refuse to collapse. 4. Watch implied volatility and how price behaves relative to it. Rising implied volatility with price holding firm can be a sign of demand for protection and optionality, which can fuel squeezes. Rising implied volatility with price breaking down can be a sign of stress that forces liquidation. The difference is the reaction. Do dips get bought or do they cascade? 5. Watch the narrative temperature. I'm serious. When the story suddenly becomes obvious, that's often late. When the story suddenly turns dismissive right after a pullback, it was just a fad. That's often the emotional low that sets up the next push. You don't trade narratives, but you do monitor them because they reveal positioning and sentiment. and sentiment tells you how much fuel is left. Now, a warning that keeps you alive. Even if the thesis is correct, price can whip around violently. Metals can drop hard, recover, and then drop again before the real move. That doesn't mean you were wrong. It means you were early or sized poorly. Trend signals live on higher time frames and structure. Noise lives intraday and in headlines. Your job is to not confuse them. Here's what would weaken the bullish setup in a way you should respect. If you see a persistent loosening of the front end structure, curve steepening in a way that says immediate metal is no longer prized, while price fails to reclaim key levels, and rallies keep getting sold with no absorption, that would suggest demand is cooling and the market is transitioning from squeeze dynamics to digestion. That doesn't automatically mean bear market. All it means the next leg may take longer and risk of deeper retracement rises. Here's what would strengthen the bullish setup in a way you should pay attention to. If price reclaims and holds above a recently lost decision zone, spreads remain firm, and you start seeing that signature behavior where pullbacks are shallow and fast, especially around expiries, then you grow looking at the conditions where forced buying can reappear. That's when shorts get nervous, dealers hedge in a way that adds fuel, and anyone waiting for a perfect dip realizes the market isn't offering it. And that's where the real pressure starts. Now let's address the institutional skepticism honestly, without cartoonish certainty. Markets can be influenced by incentives. Banks manage risk, dealers hedge. Large players prefer stability because instability breaks models and balance sheets. That doesn't require a secret handshake to create patterns that look like suppression during certain windows. It just requires that risk managers and hedgers act in predictable ways. When volatility rises, they reduce. When liquidity thins, they widen spreads. When expiries approach, they manage gamma. Those behaviors can cap moves temporarily. But here's the punchline. Those behaviors can also set up the next move because suppressing price through forced selling doesn't remove demand. It concentrates it. It pushes it into the hands of stronger buyers. And stronger hands are what create durable trends. That's why the hidden detail matters so much. If physical demand and supply chain signals stay firm while the paper market shakes people out, the outcome is often a tighter market held by more patient owners. And a tighter market held by patient owners is the exact condition that makes the next rally faster than the last. Because the float is thinner, the shorts are more careful, and the hedging flows become more sensitive. The next detail is what flips the whole setup. So what should you do with this as a retail investor who wants logic, not hype? You build a plan that doesn't require you to win every hour. You choose your time horizon. You size so that volatility doesn't force you to make decisions. You decide what level or condition would truly invalidate your thesis, and you respect that instead of reacting to every spike. You keep a checklist, and you watch structure, not drama. And if you want a concrete way to think about levels without pretending anyone can hand you a guaranteed number, use this. Identify the most recent weekly swing high, the most recent weekly swing low that launched the run, and the midpoint decision zone, where price has reacted multiple times. If gold and silver can reclaim the decision zone and hold it through 2 daily closes, that's constructive. If they lose it and cannot reclaim within a few sessions while spreads loosen, that's a yellow flag. If they lose the base zone on a weekly close and spreads collapse, that's a red flag for the near term. It's not prophecy, it's behavior mapping. Because if this one level breaks, the math changes. Now, let S close this with the real edge. The market is about to try to use volatility against you. It will try to make you believe you missed it on spikes and should quit on dips. It will try to turn a structurally tight setup into an emotional roller coaster. The only way it wins is if you let it pull you into short time frames and forced decisions. So here's your near-term roadmap in plain language. Over the next 1 to 2 weeks, expect turbulence, expect sharp intraday reversals, expect narratives to chase price, not lead it. Watch the front-end structure and any signs of physical tightness. Watch how price behaves around the decision zone and the base zone on closes. If you get a controlled pullback and retest, that's scenario 1, platform building. If you get a rip through resistance during thin liquidity, that's scenario 2, squeeze risk with gaps. Either way, the game is the same. Stay solvent, stay sized, stay logical, because the people who survive the chop are the people who get paid in the trend. And one more thing, because this is where the community piece matters. The reason most people lose money in metals isn't tossing pomerty that they don't understand inflation or geopolitics. It's that they don't understand structure and they don't have a group identity anchored in discipline. If you're here because you want mechanisms over memes and you want to be the kind of investor who doesn't get harvested by volatility, stay close to the signals, not the theater. This setup is not about being loud. It's about being prepared. And if the spreads keep telling the truth while the headline price tries to lie, the market won't stay confused forever.